if you look at all of the fears that are already known, the chief one that's on everybody's minds, this latest Ukraine-Russia conflict and whether or not they will escalate, etc. You've got inflation. And then you've got the risk of how central banks around the world, it's not just the Federal Reserve, are going to raise interest rates and shrink their balance sheets and what that will do to the global economy. So you got three main risks that everyone is obsessed with. Then you have a secondary risk, which is the Fed going to slow down the economy to a recession? So now there's a recession fears baked into the way that the global markets are trading. And fifth, and this is another one that's talked about, etc., is the problem with iOS and privacy, which is shaking up the competitive advantage of the world's biggest company. These are big things that the market is already factoring in. Right. So the saying goes, you start buying when the cannons start firing, right? You want to buy when there's blood in the streets. And right now, there's a lot of blood in the street.
Welcome to another RTD interview. Today, I'm excited to have returning guest, Mr. Lior Gantz, the editor and founder of the Wealth Research Group. And today, Lior joins us to share his thoughts on the current economic conditions, as well as some strategic investment ideas on how to navigate the waters ahead. So, Lior, welcome back to RTD Interviews.
Nice to be here.
Well, Lior, I appreciate you taking time to sit down with us. It's been a while. Actually, I think it's been over a year, so a lot of things have gone on since then. But for those that may not know, can you give us a brief rundown as to who you are and some of your background real quick, if you don't mind?
Sure. Wealthresearchgroup.com is a free financial newsletter where I try to cover in 3 weekly articles everything that's going on in the macroeconomics and the investment world. Basically, I speak with a lot of CEOs and hedge fund managers, and I also do my own research, and I try to condense everything that I'm reading into articles that I can share.
All right. Well, I appreciate you for sharing that. So I want to jump right in. We are towards the end of February, 2022. Lots of things unfolding right now as we speak. And I'm curious at this current moment, what concerns you the most? What are you keeping an eye on at this very moment?
In terms of like the markets and the global economy, I'm actually not concerned at all. There's so much fear factored in to global stock, to the stock market right now, and to the bond market, that I think we're actually in a really good spot in terms of the risk reward for risk assets. If you look at all of the fears that are already known, the chief one that's on everybody's minds is this latest Ukraine-Russia conflict and whether or not they will escalate, etc., and how it will impact one, NATO, which involves a lot of Western countries, and 2, oil prices. You've got inflation, which has just been horrible for months, and everyone, including mainstream media, understands that the CPI is obviously understating what's going on. And then you've got the risk of how central banks around the world, it's not just the Federal Reserve, are going to raise interest rates and shrink their balance sheets and what that will do to the global economy. So you got 3 main risks that everyone is obsessed with. Then you have a secondary risk, which is the Fed going to slow down the economy to a recession? So now there's recession fears baked into the way that the global markets are trading and whatnot. And fifth, and this is another one that's talked about, etc., is the problem with iOS and privacy, which is shaking up the competitive advantage of the world's biggest companies, and that has caused Meta platforms or Facebook to drop by 23% in one day. It's the largest one-day loss for any company in history. $230 billion were wiped from the market cap. You saw a lot of this going on in January. It was the worst January in stock market history. And so you're seeing that this new environment around the monopoly and monopoly-like power that these companies have had is diminishing, and that's also obviously hurting the S&P 500, the Nasdaq, which are very concentrated in these names. So you got five main, big, known, ultra panicking risks, and they are big risks. The thing is, they're so known that it would take a true disaster to further escalate the situation. So in terms of the way I look at things, I say, man, these are five big, big risks, and everybody knows about them. Everybody that would have sold could have sold already. Earnings season, you see companies beating on top line, on bottom line. Afterwards, the stock sells off 10, 20, 30% on guidance. So all of these companies are also saying, hey, we see a big slowdown. So they're even giving you low expectations. So all the bad stuff is in front of you. The only thing that can happen is if China invades Taiwan, or a huge cybersecurity problem creates something that's not factored in right now. But the rest of it, I mean, look, we're factoring 7 rate hikes in 1 year. We're factoring a 0.5% rate hike in March and 0.5% in. I mean, these are big things that the market is already factoring in. Right. So as the saying goes, you start buying when the cannons start firing, right? You want to buy when there's blood in the streets. And right now, there's a lot of blood in the street.
Let's dive that out further. So you gave us five risk factors that worth keeping an eye on, of which at any moment anything can give, creating more panic and fear in the markets. Therefore, really causing some unfavorable market conditions for a lot of people, as far as a lot of wealth being transferred or lost. And so, right now, Ukraine and Russia, as we speak, I saw that their equities markets is taking a little bit of a dive. So that's very concerning, because whatever happens in Russia, Ukraine, in that region won't just stay isolated there. It's going to spill out beyond those regions there, dragging in the Western world as well as everybody else as well. So if something does go off in that region, the markets will respond unfavorably. Therefore, all asset classes, in the most part, will be impacted. Cryptocurrencies, gold, silver. Is that something that is already factored in as well, or am I completely off with that, you think?
Well, what you just shared is the worst case scenario. So that's a full invasion in NATO. I don't think that's. I give that a 5% chance.
Okay.
What Putin is gunning towards is more of a situation that's a lot like what, and I'm not comparing the two, but what happened with France and Germany and Hitler, where he said, look, there's a region here where, and it's called Alsace-Lorraine, and this is back almost 80 years ago, and the Germans said, look, you occupied this after World War I. In other words, they told the French, look, you took this from us after World War I. We want it back. And if you do a survey of the population, they'll tell you that they're pro-Germany. And so on a similar type note, what Russia is saying is, look, there's an area in the Ukraine that's pro-Russia, and we want to annex it back. We want it back. That's more of what I think will happen, not a full-on invasion where there's a lot of players. There's just too much to lose for Putin and not much to gain in terms of sanctions and otherwise. In other words, I don't see it escalating into a full-blown conflict. And even if it does, you're talking about a few days before it turns diplomatic. That's 95%. Okay. So the way I think about it in terms of if I'm buying stocks or real estate or anything else with a 5-year to 7-year horizon, this doesn't register as a big risk to me.
All right, so let's jump into the Federal Reserve. I call it the ultimate trifecta. They're trying to remove accommodative policies, i.e. dial back on the bond and mortgage-backed securities, as well as raise hikes, as you mentioned, possibly 7 times, and quantitative tightening, removing what they've already put out in the system to basically provide a lifeline for the system. And so will they be able to execute that? And is there something that we're not looking at? Is there something else that we're probably not seeing, which allows them to think that they can get this done?
The market is giving green light to central banks and to the Fed to raise rates. The markets think that that's a good idea. So that's good. When things go wrong is when the Fed thinks one thing and the markets think a completely different thing. That's when the markets, throw a tantrum. They either investors sell off stocks or something else. The Fed and the markets do not agree. That's called either behind the curve or ahead of the curve. Right now, it looks like for a long time when the Fed kept saying transitory, the market believed it and stocks kept going up. And then the Fed, after, especially Jerome Powell, after Biden told him, look, if you don't change your stance on inflation publicly, this was November 4th, 2021. If you don't change that, I am losing credibility. People are seeing inflation. You're talking about transitory inflation. This is costing me the elections. And if you want to get reconfirmed, this is obviously behind closed doors, but this was certainly the vibe in the meeting. Then I need you to change what you're saying. This is not transitory. So obviously Powell wanted to get reconfirmed, so he kept saying transitory because he wanted the markets to keep rallying in a year where he had to get reconfirmed. Once he got the reconfirmation from Biden, he totally flipped and said, we have to retire the word transitory. This kind of flip-flop is what caused the markets to peak. If you look at the QQQ, which is the NASDAQ ETF, or the SPY, which is the S&P 500 ETF, they both peaked in November, right after he flip-flopped. So the markets don't like when the Fed says something and they either disagree or it surprises them. And that's what happened. And in January 2022, the Fed reiterated that inflation is a problem, and I think what the markets are really afraid of is that they said, if we raise interest rates, that's going to solve only a little part of the problem. The big problem is not the demand. Fine, there's a lot of demand. The problem is logistics. The problem is that U.S. ports are just a shit show, for lack of a better word. There are just in the port of Los Angeles and Long Beach, which are 40% of incoming imports. There's a shortage of, I think, 8,000 workers. Just in the port itself. Mm-hmm. You have a shortage of 80,000 workers, not 8,000, 80,000 workers. There's a shortage of 400,000 warehousing workers and truckers combined. You're talking about a massive shift. And why is this happening? Because during the pandemic, the only things that people could spend on are goods, not services. They couldn't go to a nail salon or get a service done. They wanted physical items, be it appliances, clothing, or otherwise. So that supply chain is going to take months and months to solve. Obviously, because of the 2 meter distance or whatever you have it in the United States, where you have to social distance, people didn't want to do public transport like trains and buses and everything. So everybody bought cars, and that caused a huge chip shortage. All this will get solved. That's not the problem. The problem is that it's causing inflation to trickle over into wages and into rents. And other things that are much more structural. In other words, the free markets could solve chip shortages, or the free markets could solve other shortages in manufacturing, and bring back jobs. The problem is that the government sucks. Ports are not going to work better. There are unions involved. There's just an incredible lack of automation. Just to give you an idea, the port of Los Angeles, which is one of the biggest ports in the world, is ranked 328 in efficiency. There's a port in Tanzania that's ranked better. So, these are big things. They're not going to get solved easily. And the Biden's administration is not easing with regulations. It's not helping. There are 2,000 ports in the United States that can help. There's a Jones Act where it's a rule from 100 years ago that doesn't make sense. and it's clogging up ports as well. So my big answer to you is that I think the Fed should raise rates. The markets wanted to raise rates. Raising rates will not solve inflation. It can tame down the economy a little bit, force people to make more educated decisions about originating mortgages and business loans, etc. It's only a third of the solution, and therefore I think it's a step in the right direction, but we still have a long ways to go. The flip side of it, Mike, is there's such a giant opportunity for entrepreneurs and workers in America right now. There's so many things to solve, and you should get involved.
Right, no doubt. Now, one thing I want to definitely touch on before we get into some of the strategic ideas and solutions, entrepreneurship being one of them, the current overpriced or the overpriced valuations of the current equities markets here in the U.S., as well as the real estate market, the debt concerns. Those are all the things that, you know, the average person in the alternative media is really focusing on. Because if there's no additional accommodative policies offered to the markets, you know, we know that the equities markets have paralleled the amount of stimulus. I think we've 3 or 4 different packages over the last 2 years. Now the Build Back Better is stalled, and that's, I'm assuming, going to be a problem as well. What's the likelihood this year that there is a correction? Given the events that we do know, or possibly the ones we do not foresee coming, what's the likelihood that there is a systemic correction, which then allows the Federal Reserve to backtrack and force them to have to go in the opposite direction of the way they're talking?
My opinion is very low.
Very low. Okay.
We had a huge panic. The entire world shut down in March 2020. Literally, the entire world shut down. And you saw the markets go down by 35%, and then a rescue package. And then, Mike, the world has gone through one of the biggest stress tests to companies, to individuals, to households, to governments. I mean, we are in a better situation in terms of what we are capable of. We went through one of the hardest periods for modern economies. In the last 20 years, we went through a huge tech bubble, fixed that. We went through a real estate bubble, fixed that. We went through a global supply shutdown where you had 4 billion souls at home at one point. Past that, you need to look at the other side of this. Mm-hmm. We're probably in the first innings of a major boom in America. American demographics are phenomenal. You have 75 million millennials on the up and up with better wages, better career prospects. They have not yet built homes. There's a huge shortage of homes. If you're not into real estate in any capacity, you should get into real estate right now. Anything you can do that has to do with real estate, you should look into it. Part-time, full-time, whatever the case, you should get into real estate. There's a huge shortage of homes, 2 million homes short. And there's big migrations in America. People are flooding from California to Texas to Arizona. People are moving away from New York to Florida. Homes are needed. There's so much opportunity in real estate right now. And it's only going to grow because the millennials are right now about 35% of the workforce, and they're going to be 75% of the workforce. They're going to accumulate a lot of wealth in the next 10 years. They're underinvested in equities by trillions. Trillions of dollars are going to flood into equities in the next few years. This is very similar to 1990. Very similar. You had in 1987 a big crash with the saving and loans crisis. The boomers got into the 90s where they entered into their 30s. There was a big innovation boom because the 30s in your life is when you make up your best ideas, your best companies. That's where we are right now. Don't look at this doom side right now. It's just not there. History says that when the Fed starts to raise rates, starts, not finishes, equities love it. They applaud the Fed for taking the right action. Gold is historically in the 6 rate hike periods that we've seen since 1971, since the decoupling from the gold standard, the Fed has done 6 rate hike cycles where it says, okay, I'm going to start raising rates. Twice in the 70s, we had one in the 90s, 2 in the 2000s, and one between 2015 and 2018. Each of these 6 times, gold has rallied 100% of the time. Historical history says you start raising rates, gold loves it. And the reason is because when you start raising rates, the next cycle is debasement because you're going to ease economic policy, and the markets are always forward-looking. So right now, with 7 rate hikes already baked in the cake, and you got gold at 1900, I mean, gold historically in this 6 rate hikes has gone up by 30% on average. 30% of 1900 is $570. So, I mean, it wouldn't surprise me to see all-time highs this year. It would surprise me to see gold at 2400 by the end of 2023. We are at the early stages of a massive gold bull market. If history repeats, I think the key things to watch are: 1, you need to see silver go up above 25 and then above 29, which is where the big resistance is. That's going to be a big confirmation. You need to see the DXY index, which is the dollar index, go below 90. That's a second confirmation. And then you need to see gold go above 2000. That's a third confirmation. If those things happen, the risk reward in gold and gold equities is about an 85% chance that you're entering a huge bull market. So you can speculate on whether or not it will happen, take more risk, get more upside, or you can wait for these confirmations, 1 of them, 2 of them, the whole 3, and then take action. We put together a huge economic report for 2022 with this outlook and many more things for your viewers at wealthresearchgroup.com/2022 or 2022. I think that encapsulate a lot of the things I said and more, with charts and graphs and everything that you can download there. And I think that's going to be very educational, and you can take time and research that.
Sounds good. Well, Lior Gantz, as always, it's good to have you on the show to give us your perspective on where we're at, where we're heading. And definitely, the viewers, I'm sure, will be very happy to hear the possibility of all-time new highs, because I've been having more guests come on sharing their perspectives, and everyone feels that gold and silver, it's their time to shine. And so hopefully that is the case, but definitely have you back on sooner than later and then get your thoughts on where we're at that point. But for those that may not know, are you also on social media or whatnot, or just wealthresearchgroup.com or what?
Wealthresearchgroup.com is the website. I think on the top menu, you'll find a lot of great features that you're going to love. One of them is called Live Portfolio, where you can access my live portfolio. You access it on the top menu tab. There's another one that's called Watch List. These are all of the stocks that I'm looking at and the prices that I like to get in. There's another one called Special Reports, which is a wide array of PDF downloads that I think are great education. And the newsletter is really the flagship, where I connect real time with the readers, and that's a free newsletter. It basically is my way of transferring everything that I'm reading and learning and studying, and I think I do it better by writing it for myself and then sharing it. That's the process that I do. I want to leave you with one last thing, Mike.
Go ahead.
Okay, inflation. When the CPI is at 7% or 8% or 11%, it doesn't matter. What it means is that prices have risen year over year by 11%. For this to keep going on, in other words, for CPI to remain at 7% next February, what you're saying basically is that you think everything will go up by another 7%. Mm-hmm. So just keep that in mind. We've had the Delta, we had the Omicron, etc. So we're comparing to periods where China, with their zero COVID policy, shut everything down, and prices were obviously above where they are. As we're reopening, these concerns will alleviate because all the factories will run smoother, more ships will have less delay times in ports, etc. And CPI is going to start going down, not to deflationary numbers, but it's certainly going to go down. At the same time, the US population is growing at about a 1.5% to 2% average year over year, while GDP is growing about 4 to 4.5%. That means that every generation accumulates an extra $100,000. So, I mean, America is in a much better place than Europe, where you have awful demographics, just awful. Countries are shrinking. They don't have youth. They don't have millennials that are going to give them a lot of tax receipts, build their real estate, etc. Japan, for example, has become the first developed nation to shrink in population. Japan is at 120 million people right now, and by 2050, they're going to be at around 70 million people. That's unprecedented. There's never been a country like it. There's more adult diapers sold than baby diapers in Japan. America is not in that situation. So while Americans love to be self-criticize, and that's part of the greatness of America, the situation is America continues to be the motherlode for innovation, for construction, for real estate, for anything, if you can figure out a way to connect with it. Because as we all know, if you're not connecting with the American dream and the American way, to be an average worker in America is horrible. You don't get the same style and lifestyle and cushions as you do in Europe or in Canada and other more socialistic countries in terms of working hours and whatnot. It's a very capitalistic society. Figure out the way that you can connect with that system, because it brings prosperity. And if you can't, then yeah, we're going to keep hearing a lot about people that work for minimum wages and they can't sustain and whatnot. This is part of the reality in America. I don't think any president will change it, and I don't think any regulations will change it. This is the free enterprise system with its winners and with its victims. So I made that decision. I could fight the system, or I can figure out my way of connecting with it, and then sharing and educating others instead of trying to fight something that I can't win.
All right. Sounds good. Well, Lior Gantz, thank you for that summary there. And as always, it's great to connect, as I mentioned. Definitely looking forward to having you back on the future. And we'll just see where we head into this current year. But other than that, thank you for your time on RTD Interviews.
Thank you very much.